Candlestick analysis is a very fascinating subcategory of technical analysis and is one of my main areas of expertise, so I'm very excited to record this lecture. Generally, traders conduct candlestick analysis through popular patterns that have been studied through the years. In my opinion, candlestick analysis is an art that is not limited only to popular patterns, as every candlestick is a piece of information that can help you understand why and how prices move in financial markets, which will allow you to make better trading decisions. In this lecture, we're going to study some popular candlestick patterns, but I will explain the logic behind them, so you will be able to understand and trade even other less common candlestick patterns and candlesticks that do not form any popular pattern. Before starting with the first formation, let's get familiar with two terms that you will often find in trading. These terms are bullish and bearish. The bull is the symbol of a rising market, while the bear is the symbol of a falling market. So if you hear the market is bullish, it means it's going up or it is expected to go up. Same if we have a bullish candlestick pattern, it indicates that that pattern is showing a possible uptrend coming. If you hear the market is bearish, it means it's going down or it is expected to go down. Same if we have a bearish candlestick pattern, it indicates that that pattern is showing a possible downtrend coming. It is said that this terminology derives from the way in which each animal attacks its opponents. A bull thrusts its horns up into the air, while a bear swipes down. In Wall Street, there is also an iconic statue called Charging Bull, symbol of prosperity and rising markets. It is a very popular destination that draws thousands of people a day, and it is said that if you touch it, you will have good luck with your trades and your investments. But don't worry, you won't need to go there and touch the bull for good luck, because with this course, you won't need any luck. Okay, it's time to analyze the first very popular pattern called bullish engulfing pattern. This is not one of the easiest patterns since it is formed by two candlesticks and not just one. The first candlestick of the pattern is generally red, which indicates that the price was going down. The second candlestick of the pattern is a big green candlestick that engulfs the first one, which shows that buyers had a very strong reaction and now are pushing the price up. Let's have an example with real market conditions so I can show you the logic behind this candlestick formation. Here we have euro-dollar on a 4-hour chart. In the first part of this chart, it seems that we have a clear downtrend. The price was forming lower highs and lower lows. At one point, we have this candlestick formation called bullish engulfing pattern. Let's try to understand the action behind these two candlesticks. The first candlestick is a red one. It indicates that the price was going down. This is in line with the trend we had on the market, because the price was in a downtrend, so a red candlestick is what traders would expect, so everything is following a certain logic. The market is in a downtrend, we have a red candlestick. The next candlestick is a big green candlestick, much bigger than the red candlestick we just had in the previous session. What does that mean? It means that at this price, buyers start to find convenient buying, and they showed it with strong action that formed such a big green candlestick. Now, before this green candlestick, sellers had been completely in control of the market, pushing the price down, showing a clear downtrend for this currency pair. Now, for the first time, we see a serious threat to this downtrend, as buyers made it clear that they find this price quite convenient. That is why the engulfing pattern is considered a reversal pattern, because the action expressed by this pattern indicates that the trend may reverse. In this case, it may go from a downtrend to an uptrend, which is exactly what happens here. Candlestick analysis can be particularly useful when used in combination with what we have studied so far in this section. Here we have pound against Canadian dollar on a daily chart. The price is clearly going up, so I want to draw an uptrend line and see if I can connect the higher lows and define a market structure. Now that we have our uptrend line, let's see if we can open a trade. Here, the price is approaching once again our trend line, so what do we usually do? We wait to see if there is a rejection, and then we enter with a long position. Now, look at what happens here. The price is going down, then we have a small red candlestick that tests the level of the uptrend line, and right after that we have a very strong green candle that engulfs the previous one and pushes the price all the way up. This is a strong indication that buyers are back on the market and the demand is increasing, exactly what we were looking for to enter our long position. So we place our trade here and the usual stop loss below the trend line, and for the take profit we can place it above the previous high we had on the market, so something like this. You can notice that if you missed this trade, you will have had a second chance here with a second bullish engulfing pattern right on the uptrend line. The opposite to the bullish engulfing pattern is the bearish engulfing pattern. Here on US dollar, Canadian dollar 1 hour chart, we have a clear downtrend, so we can try to draw a downtrend line connecting lower highs. After a few bounces that confirm the downtrend line we have here, we want to try to catch an opportunity to open a short position on a rejection on the downtrend line. Here we have one opportunity and it comes with a bearish engulfing pattern. This formation is exactly the opposite to the bullish engulfing pattern, so let's try to figure out what's going on the market. Overall, the price is in a downtrend, but here it is going up and it is about to approach our downtrend line. As usual, we want to wait and see if there is a rejection to open a short position. If we focus on these two candlesticks that form the bearish engulfing pattern, the first one is in line with the up movement we were having. The price was going up in the recent sessions. This candlestick just confirms that. The second candlestick is a strong red candlestick showing that sellers reacted and are pushing the price down, taking control of the market. This is exactly what we were waiting for, some action that confirms that sellers are strong, so in line with our view of the market and with the short position we were planning. So we open a short position here with the stop loss above the downtrend line and the take profit below the last low we had. The next pattern we're going to see is the hammer and hanging man, which is another reversal pattern suggesting a change in the direction of the market. They have exactly the same formation, but we call it hammer if we have it during a down movement and hanging man if we have it during an up movement. This candlestick pattern has a lower shadow that is significantly bigger than the body. It also has little or no upper shadow, and the color of the body can be either green or red for this pattern. Here we have pound against US dollar on a 1 hour chart, and this is a chart we have analyzed in a previous lecture. There are two very powerful hammers on this chart. One is here and the other one is here. We're going to study the second one and see if we can understand the action behind this candlestick and eventually open a long position. Let's zoom in so we can focus specifically on this candlestick. What can we say about it? The long lower shadow shows that in the first part of the hour forming this candlestick, sellers were in control. The price was going down and it formed a new low. This is in line with normal market expectations, as the price was coming from a strong down movement. In the second part of the session, buyers managed to push the price all the way back, hence the formation of this lower shadow. In this case, the candlestick also closed with the price above the opening price, which is an extra confirmation of the strength that buyers had during this session. Now, think about it. In the first part of the session, sellers were in control, pushing the price down. In the second part of the session, buyers reacted, pushing the price back up above the opening price. Considering this market action, would you be more in favor of a long position or a short position? Buyers closed the session in control of the market, and the expectation will be that they remain in control at the opening of the next candlestick, suggesting that the price may now start to go up. This is why the hammer is considered a bullish reversal pattern. It indicates that the down movement may come to an end and leave space to an up movement. So here we can open our long position right after the formation of the hammer, or even wait and see if the price really starts to go up from here. So we could open our trade here after a few green candlesticks, and then stop loss outside the market structure and take profit inside the market structure. Pretty easy. As I have said, this candlestick formation can be either a hammer or a hanging man. In this case, we had a hammer because it appeared during a down movement. If we have the same pattern following an up movement, we refer to it as a hanging man. In this chart, we have a good example of a hanging man right here at the top of this up channel. Now, generally speaking, the hanging man is considered a bearish pattern, and you can see that it also worked here as the price starts to go down not long after the formation of a hanging man. But with an analysis of the action inside the candlestick, we have just seen that the session closes with buyers in control of the market, which suggests the up movement may continue. So I will not consider the hanging man as a bearish pattern, and we are not going to use it in this course. In the course about candlestick pattern, I talk more in detail about the hanging man, and I share extensive data that proves that historically the hanging man has had a lower win rate compared to other candlestick patterns in similar market conditions. So again, we are not going to use the hanging man. The next pattern is the shooting star and inverted hammer, which is another reversal pattern. They have the same formation, but we have a shooting star when it appears during an up movement and an inverted hammer when it appears during a down movement. This candlestick pattern has an upper shadow that is significantly bigger than the body, and it has little or no lower shadow. The color of the body can be either green or red for this pattern. If you notice, this is kind of the inverse of a hammer or hanging man. Here we have US dollar against Swiss franc on a 4-hour chart. The price is going down, forming lower highs and lower lows. I think I can also try to draw a down channel here. Let's see how it goes. Yes, although there is an area with some candlesticks going slightly above the down channel, overall this chart pattern seems to represent very well what is happening on the market. So we want to look for short positions when we have a rejection in the upper part of the descending channel. Here we have the price going up, testing this key level, and then it starts to go down. Let's focus for a moment on this candlestick. What does it say? The long upper shadow indicates that in the first part of the session, buyers were totally in control, pushing the price higher. This followed the expectation of the market as the price was coming from an up movement. In the second part of the session, sellers started to react, pushing the price down. That is why we have this long upper shadow. So in the first part, buyers were in control as expected because we were already having an up movement before the formation of this candlestick. In the second part, sellers reacted, took control of the market, and pushed the price down. Now, after this kind of action, would you side with buyers or sellers for the next candlestick formations? We'd rather side with sellers, as we have seen that sellers were the one in control of the market by the end of the session that formed this candlestick. So this shooting star is a good indication that the market may reverse from an uptrend to a downtrend, or in this case, may indicate that the up movement may come to an end and the long-term downtrend we were having may resume. If this is not enough to open a trade here, what do we have next? A strong red candlestick that also forms a bearish engulfing pattern together with the shooting star we have just analyzed. So we can enter a short position here after a double confirmation that the price is going down, stop loss above the channel and take profit at the bottom of it, and voila, the trade is served. In the same chart, we have an inverted hammer right here, although probably not the best one, as the candlestick is very small. When we search for candlestick patterns, we always want to look for candlesticks with a good size, which indicates that there's been a lot of action during that session. Anyway, just like we are not going to use the hanging man, we are also not going to use the inverted hammer. What's the reason? According to popular belief, the inverted hammer should be a reversal pattern during a down movement, so it should be an indication that the down movement may come to an end and there may be space for an up movement. Remember the action inside this candlestick. Buyers were in control in the first part of the session, but sellers took over and are now pushing the price down. So, if anything, this should be interpreted as a bearish signal indicating strength in favor of sellers, not the other way around. Since popular belief doesn't match with the logic of the pattern, and once again, in the candlestick analysis course, I have data that has been collected through the years that supports my theory, then we're not going to use the inverted hammer. The next candlestick pattern we are going to talk about is the doji. A doji is a candlestick with little or no body. Because the opening and closing prices are so similar, the color of the body doesn't really matter for this pattern. There are many different types of dojis, but the three main types that traders consider are dragonfly doji, in which we have a long lower shadow but little or no upper shadow. We have already seen something very similar to this with the hammer and the hanging man. This pattern expresses exactly the same kind of action, and so we are going to trade it exactly the same way as the hammer, but technically we call it dragonfly doji because it has no body. Then we have the gravestone doji, in which we have a long upper shadow but little or no lower shadow. And inverted hammer. Again, it expresses the same kind of information and we are going to trade it just like a shooting star, but we call it gravestone doji because it has no real body. There is a third type of doji that doesn't resemble any other candlestick formation we have seen so far. It is the long-legged doji. A long-legged doji has a long upper shadow and a long lower shadow. Since it is a candlestick configuration that we haven't studied before, we are going to study it with a real market example. Let's go back to the same chart on US dollar against Swiss franc. We have several long-legged dojis here, but I want to focus on one that is also very close to a key level, so I'm going to take this one as an example. What's the action behind this candlestick? For the whole session, buyers and sellers tried to take control of the market, pushing the price up and down, hence the large shadows. At the end of the session, the price closes near the opening price, forming a very small body. So this pattern shows an intense fight between buyers and sellers, but in the end, no one prevailed, which indicates that there is indecision on the markets. As usual, when we study the action inside a candlestick, it is important to relate it to the previous market conditions. The market was on an up movement, then we have a long-legged doji that expresses indecision. So how do we read this situation? Buyers were quite confident in pushing the price higher and higher, but all of a sudden sellers reacted and we have an intense battle with the price going up and down during the session and ending up near the open price. So first there was confidence in the up movement, now there is indecision, so buyers are not so confident anymore. So how do we use this candlestick pattern? Remember that the long-legged doji expresses indecision, and you may not want to buy or sell in this case until you have more information. So we generally use it as a first indication that the trend may change, but we wait for further action to see where the market is heading. In this case, the next candlestick is a strong red candle, which is the confirmation we were waiting for. If we open a short position here, we can place our stop loss above the descending channel and take profit at the bottom of it with a nice profitable trade. The last pattern we're going to see is called Marubozu. This candlestick formation has a big body and little or no shadows. It represents large movements in price either up or down, so it can be green or red. We call it bullish Marubozu if it is green or bearish Marubozu if it is red. Here we have New Zealand dollar against Swiss franc on a daily chart, and I really like this Marubozu that we have right here, specifically a bearish Marubozu. How do we trade it? We have identified that the market is in a downtrend, the price just approached the downtrend line, we had a candlestick that resembles a long-legged doji expressing indecision, followed by a bearish Marubozu, which is a candlestick that expresses total power by sellers. Do we need anything else to open a short position here? I don't think so. So we enter here, stop loss above the downtrend line and take profit forming a new low. In this case, we can also go a bit lower to get a good risk to reward ratio. Don't worry, we will talk about the risk to reward ratio in the risk management section.